Someone asked me recently, do you think the market's overvalued right now? And I'll be honest, it's probably the most common question I get as a financial planner. Here's the tricky part. There's no simple yes or no answer. Some areas of the market are stretched, others are cheap, and the market as a whole is rarely, if ever, perfectly priced. So today I want to walk you through how to think about valuations, what history has taught us about chasing trends, and most importantly, how you can invest smartly without getting caught up in the noise. Quick intro if we haven't met. I'm Kareem Taloon, a certified financial planner and founder of KT Wealth Management. I work with individuals, families, and business owners to help them retire with confidence through smart, tax-efficient financial planning. When people say the market's overvalued, what they usually mean is that stock prices are high relative to earnings. One of the most common ways to measure that is the price-to-earnings ratio, or PE ratio. Right now, if you look at the S&P 500, the PE ratio is definitely above its long-term average. Does that mean the market is guaranteed to fall? Not necessarily. Interest rates, inflation, and future growth expectations all play a role in what investors are willing to pay. And here's the thing. Valuation is not black and white. One sector might be expensive, while another looks cheap. All at the exact same time. Not all markets are the same. Big tech stocks grab all the headlines, and yes, many of them are trading at higher than usual valuations. That's where the overvalued market story usually comes from. But when you zoom out, there's more to the picture. Small cap stocks, for example, are trading at a discount compared to their history. International markets like Europe and parts of emerging markets are also priced much lower than the US mega caps. So is the entire market overvalued? Not at all. It really depends where you're looking. Now let's talk about what happens when investors get caught up in the herd mentality and chase whatever's hot. We saw it in the dot-com bubble of the late 1990s. Companies with no profits, sometimes not even a real business model, were worth billions. And when reality set in, most of those stocks were wiped out. Fast forward to the COVID era, a wave of profitless tech companies skyrocketed as everyone piled in. But once the economy normalized and opened back up, most of those names collapsed. And more recently, we've seen the same thing with meme stocks and speculative crypto surges. FOMO drove prices higher, and the last people in were usually the ones holding the bag. The lesson's simple. Just because everyone's running in the same direction doesn't mean it's the smart move. Okay, so what about trying to time things? Some investors say, I'll just wait until the market isn't so expensive before I buy in. That sounds good in theory, but here's the reality, it usually backfires. The market is forward-looking. By the time valuations look attractive, the rebound has already started. History shows that if you miss just a handful of the best days in the market, your long-term returns can be cut in half. In other words, waiting on the sidelines for the perfect moment almost always costs you more than just sticking to your plan. So what's the smart money move? Number one, don't try to call the top or bottom. Nobody gets that right consistently. Number two, stay diversified. Own different sectors, different sized companies, different asset classes, different geographies. That way, you're not putting all your eggs in one basket that happens to be overheated. Number three, rebalance. If one part of your portfolio runs hot, take a little off the top and reallocate to areas that look more attractive. And most importantly, focus on your goals and your time horizon. If you're investing for the next 20 or 30 years, short-term valuation noise isn't nearly as important as staying the course. So is the market overvalued right now? Parts of it, yes. But the better question is your portfolio positioned to handle both the ups and the inevitable pullbacks? That's where financial planning really makes the difference. If you found this helpful, hit the like button, subscribe to the channel, and check out my other videos where I break down how to make smarter money moves, no matter what the market's doing. See you on the next one.